Welcome everyone to this video on bid and ask price. In the previous video we looked at buying and selling, and what I wanted to do is show you one example, a live example of how you'd go about conducting, for example, a buying trade or going long in the market. So so now I'm going to move on to my iPad. So this is a live example of a Forex trade that's going to be conducted. And this is the app 2on2 trading app, and this is a demo account. And the point is to show you how to open and close a trade. I don't normally trade at this time, but I just want to show you how to open and close trades. I'm sure some of you have downloaded this app and are unsure about undertaking this task of opening a trade and closing it. And if you look on the right, you'd see that that is the currency rates. So it's going up and down, and this is the euro against the Australian dollar. This is a line chart for it, and at the bottom you'd see the time. So right now it's the 20th of August 2018, and it's around 11:40 p.m. So I'm predicting that the chart, the euro against the Australian dollar, is going to go up. So there's going to be a bullish trend. And if I want to do this, if I'm predicting this, then it would mean I would conduct a buy-in trade. So I would go long. And I'm just going to use one of the useful tools on the 2on2 trading app. If you look on the top right, there is three buttons, not buttons, three dots, and I'm going to click on them, and I'm going to make a line just to show you what I think the graph is going to go roughly. So it's going to go roughly right there. That's my prediction. And what I'm going to do is, if you look on the top left, you'd see there's a sell and a buy, and then the values underneath them. And it's just turned green now, the tab. I'm going to press the buy because I want to buy into the market, because I'm basically predicting that the value is going to go up. And then press buy. And now I've bought. So it says, if you look on the top now, there's a new tab that says direction buy, and result, we're in minus £1,084. So I'll show you what happens after. Welcome back everyone, and as you can see, time has progressed and I'm on £3,139. And so I want to close this transaction. And what someone might think, a beginner would think, that if you've bought into a trade, to close that trade you'd sell it. And on the top left there is a sell button, but that is only to conduct a sell or short selling transaction. That's not the closest position. That would open another position, a selling position. So to close this buying position, you just the words on the top right in red, you click it, and it says, are you sure you want to close this FX euro against Australian position? You press OK. And now it says you sold, blah, blah, blah. And so that is how you open a position. I hope you understand that. So now we'll be moving on to bid and ask price. So a Forex broker would be giving you two rates, one for when you conduct a selling transaction and one when you conduct a buying transaction. So which one's which? Well, bid is the price for selling a currency when you're going short on a currency pair, and ask price is the price for buying or longing or going long on a currency pair. And the price of these are given by a Forex broker. So let's take an example. So over here is a picture of an exchange bureau in the UK. So exchange bureau in the UK, and as you can see, let's just focus on the USD. So it says that it says a sell and a buy price. For the sell price, it is 1.26, and for the buy price is 1.3888. Now the sell price is known as the bid, and the buy price is known as the ask. So what does this actually mean? What does this sell and buy mean? What does it mean? Well, let's just talk about sell. So when it says sell, what it means, what the bureau means is when we give them pounds and they give us dollars. So we will go there, and because it's in the UK, we will give them pounds and they will give us dollars at the rate of 1.26 per pound. And for the buy price, 1.388, what this means is when we give them dollars, they will give us pounds at the rate of 1.3888. Now, to put this into perspective, let's give an example. So let's say you give them £100. Yeah. So you're going there to convert your pounds into dollars. Let's say you're going to America. So you give them £100. They will give you $126 because the exchange rate is 1.26. 1.26 times 100 is $126. Now, let's say you come back and you haven't spent that money, $126, and you give them back their $126 and you want pounds back. They will give you not £100 back, they will give you £90 and 73p. And this comes from $126 divided by the new exchange rate, which is 1.388. And that will give you £90 and 73p. So you can see that you're making a loss of around £10. And this is how they make their profit from you. So they buy it off you at a cheaper price and they sell it to you at a higher price. And that's also how the forex brokers on the forex market also make their profit from you. And the difference between the sell price and the buy price is called spread. So the way you work out spread is the ask price minus the bid price. Now we know that ask price is the highest one and bid is the lowest one. So let's just show this calculation here. So let's just do it. So 1.3888, which is the ask price, minus 1.26. And what does that give you? Well, it gives you 0.1288. And although this is represented this way, but we want to represent it in terms of something called pips. And when you get familiar with the forex, you would understand pips and you'd hear pips so many times. And the way we calculate pips is from this example. Let me just show you an example. So let's say we have 0.0001 of exchange rate is that amount. That would equate to 1 pip. So in other words, if you get that exchange rate and you times it by 10,000, you'd get the number of pips. So let's give another example, 0.0015, and that would equate to 15 pips. And so from that example, you can calculate the number of pips from the spread. So we have 0.1288 as a spread. And how many pips is that? Well, you times it by 10,000 and that gives you 1,288 pips, which is a lot. I mean, they're charging you a lot of money for you to conduct a transaction. And if this was on a forex market with leverage of like 100, so you're trading with like £100,000, you would be making a huge loss. And thank God this is not on the as bad as on the forex market. On the forex market, the spread for the pound against the USD, because essentially this is the pound against the USD, right? Because you're from the UK, let's say you're from the UK, and you're dealing with pounds and you're going to exchange it into dollars. So this is pound, this is a pound against a dollar. And on the forex markets, you wouldn't get 1,288 pips for the spread. You'd get probably like 2 to 3 pips, which is the reason why this is insane. And another thing I would like to say is there is something else called a pipette, and a pipette is 1/10 of a pip. So 10 pipettes is equal to 1 pip, or 0.00001 of an exchange rate is equal to 1 pipette. And why is this useful? Well, in when we talk about a spread later on, um, this will come in handy. So remember this. And now we're going to move on to another example where I'm going to show you on the 212 trading app, and I'm going to conduct a buying transaction and show you exactly what I mean by the ask price. So in this example, what I'm going to show you is if you look on this chart, this Australian dollar against the New Zealand dollar, what you see is on the right, you will see the actual currency rate. And I've just highlighted it there. And what the Forex broker does is when you want to buy, the forex broker will charge a higher price. So I'm going to show you an example of where I conduct a buying transaction, and on the top left you see the green tab, and on the right is the buy, and that is what you call the ask price, and on the left is the bid price. So I'm going to press buy because I'm expecting it to go up, just to show you um, the situation I'll be in once I conduct this buying transaction. So on this graph here, I've just gone long, and as you can see, it says that you've bought, and the actual rate is here. That's the actual rate. But when I buy, I don't buy from the actual rate. I buy from a higher value. So as you can see, the actual rate is 1.1010. But when I buy, I'm buying from 1.1022. So what does this mean? It means that I must wait for the graph for the Australian dollar against the New Zealand dollar to increase, for the graph to go up, for a bullish trend to occur, for me to make a profit. But also it must go above the currency rate of 1.1022. And as you can see, it's not above 1.1022, so I'm in a loss. And if you look on the left, you'll see a green tab, and it says in small writing, Great British Pound minus £626 and 31p. So because the forex broker is initially charging you a higher price, so you're buying at a higher rate, you'll always be in a loss initially. So what does that mean? It means that if you're going to conduct this transaction, you must be expecting the graph, the currency rate, to increase a lot above 1.1022. And if you conduct 2 to 3 transactions a day, this wouldn't be ideal for you, because you would be expecting a quick profit, and you won't be obtaining a quick profit from this spread, because this spread is quite a lot. And yeah, and also the point at which you start making a profit, um I mean, the point at which your profit is equal to £0, that's called the break even. So break even basically means that you've not made a profit or a loss. And yeah, that's really all you really need to know about that. And I hope you do have some sort of understanding now about what will happen when you conduct a forex transaction, what ask and bid prices are, and yeah, let's move on to spread. So, spread can be categorized into fixed spread and floating or variable spread. And right now, I'm just going to talk to you about a spread in general. So, spread is the difference between the bid and ask price. So, as a formula, this will be spread is equal to ask minus bid price. And spread is the broker's fee. So, it's the broker's profit, how much profit the broker will be making every time you conduct a transaction, and that this is regardless of whether you're making a profit or a loss. This is like a it's sort of like a fixed thing, so they will always be making a profit from your transactions. And if you look at the figure below, which is a MetaTrader 4, if you just ignore the graph on the right and you focus on the left, and you see a list of currency pairs, and in line with it, you'll see two values. The first value is known as the bid price, and the second one is the ask price. So let's take an example. Let's take the Australian dollar against the New Zealand dollar, or AUD NZD. And the first value, which is 1.10453, which is in red. And by the way, red denotes that the currency rate is dropping at that moment in time, and blue signifies that it's increasing at that moment in time. But anyway, that value 1.10453 is the bid price, and 1.10534 is the ask price. Now, let's just take this example and try to derive the spread from it, and using that formula. So we take the highest value, 1.10534, which is the ask, and we minus it from the bid price, 1.10453, which is the bid price, and this will give us 0.00081. Now, as we did previously, we put that into pips. Now, just as a reminder, 0.0001 is equal to 1 pip, or 10 pipettes, and hence 0.00081 is equal to 8.1 pips, or 81 pipettes. And this is exactly what is shown on the MetaTrader 4 app underneath Australian dollar against the New Zealand dollar. This says spread and 81. This is what it means. And also, if you look at the other spreads, it will tell you the other spreads, and from these you can really I would like to mention three things. The first thing I would like to say is that spread denotes liquidity. The second point is that trade popular major currency pairs, and the third thing I'd like to say is trade at favorable times. So spread denotes liquidity. What does this mean? Well, the more liquid a market is, the lower the spread is in general. And if you take the example of Euro USD, which is one of the most liquid spreads, and you take one that's not popular, you will find the one that's not popular will have a higher spread than the Euro USD. So the more that people are conducting transactions, the easier it is for your broker to find a seller or a buyer, and so that affects the spread of it. And let's move on to the next point. So trade popular or major currency pairs, and this is exactly the point that I made before. So the Euro USD is a major currency pair, and if you look on the MetaTrader 4 app, the Australian dollar against the New Zealand dollar has a spread of 81 pipettes, whereas the Euro USD has a spread of 20 pipettes. And there's a huge difference there, and you might not think that the difference is huge, but when you're conducting, for example, 100 trades, the cost does add up, and in general, it's better to trade major currency pairs. And the last point is trade at favorable times. So trade when the market is at a liquid level. So let's say, for example, when the British and the American sessions are concurrent, when they're existing at the same time, this is a good time to trade. The spread will be lower. But another thing I'd like to say is that during crisis or key events, sometimes the volatility of the market will increase to a level where people are unsure about the trend of the currency, and so less people will invest in it, and so the currency pair will be less liquid during that time, so the spread will be higher. And those are the three key points I would like that I mentioned. And now I'll be moving on to fixed spread versus variable spread, because this is quite important. So fixed spread versus variable spread, and what's the difference between them, and which one's more ideal for a trader? Well, it depends. And it's very important because it when you're choosing your forex broker, it's very important that you define what type of trader you are. If you're a trader that does 2 to 3 trades every day, or if you're a swing trader, or if you trade during quiet times of the market, it all affects whether you're going to choose a fixed spread or a variable spread. And a fixed spread, it remains constant during all trading conditions. So whether the market is quiet, or whether it's volatile, or it's liquid, or illiquid, it will always stay the same. And variable spread or floating spread fluctuates in a range, so it's always changing, increasing and decreasing. And for example, the Euro USD, it differs between 1 to 5 pips during normal conditions. And I'm going to show you actually an example on MetaTrader 4 of a fixed spread and a variable spread. So yeah. So this is the variable spread, and if you look at the spread which is underneath the currency pairs, you see that it's varying, is changing values. And also notice the Australian dollar against the New Zealand dollar. Notice how its spread changes from 76, and then now it's dropping to 52. So this is a big change, and now what we're going to be looking at is a fixed spread, and noticing the difference in between them. So let's have a look at that. So this is an example of a fixed spread. So on the same app, but as the currency pairs, the currency rates, they're changing. The spread is staying exactly the same. It's not changing. And even when we go to the less common currency pairs, the same thing's happening. And this is a good thing, that there's no unpredictable changes in the market. And hope you understand the difference from this. So now that we've seen an example of fixed and variable spreads, now we can say some things about them. So fixed spreads allows traders to better strategize and manage their money without unpredictably changing transaction costs. So if you're an accurate trader and you want to make a certain amount of profit and you know how to do it, then fixed spread will be absolutely fantastic for you. And also, if you trade at volatile times, for example, key events. So, for example, the central bank is releasing important information. At these times, the market can be very volatile, which means um, uncertainty in the market. And if the spread remains constant, that's absolutely fantastic for you to take advantage of it without high transaction costs. And for example, with variable spreads, in times of volatility, even the Euro USD, which is the most traded currency pair, the spread can widen between 8 to 10 pips during this time. And so, who would variable spreads be ideal for? Well, if you trade at quiet times, it can be really cheap, like even cheaper than fixed spread. So let me give an example. Let's say you have a fixed spread, yeah, for Euro USD, and that fixed spread is 3 pips, which is constant. But you have a variable spread, but at volatile times it's very high, but at quiet times it's only 1 pip per transaction. So if you're trading in quiet times, it will be very ideal for you to take the broker who provides a variable spread. And the last point I'd like to make is that for swing traders, or those traders who trade whose trades last for like weeks or months or years, for those traders, this decision is not really applicable. It's not important to them, because um, the scale of their trade is much higher. Um, than the actual cost of the spread. And I hope this lecture has given you good understanding of bid and ask prices, spreads, and I hope you've learned something from it. And I hope to see you in the next video